For tonight's our live Q&A. I see a lot of folks already joined. Give me a thumbs up in the chat if you can hear me. I'll just assume you can. Whether you can see me or not, probably not as important. I don't know. Yeah, it's Tuesday. It's not Monday. Vinyl, yes, it was all about you. We heard that you had an investment club meeting last night, and we didn't want you to miss the fun. Or I was out of town. I don't know. You pick whatever story works best for you. So I think I'll be good for the 20th, which is 2 weeks from yesterday, for the next live Q&A. But these things can change. My life right now is not as predictable. So there you go. Omar, thank you, who gave me the heads up that they can see and hear me. So I've got the Q&A going. One of the things I learned, so during the live show, you can see the question, at least I believe you can. But for some reason, when people replay this, tomorrow or whatever, the question doesn't show up. I don't know. And in this software that I use to stream all of this, I can show a chat, like I can show, here we go. Omar saying that you guys can see and hear me. But I can't actually show the Q&A through this software. So I don't know. Nothing's perfect in life. I'll do the best I can. So I do have the questions. Keep asking them, and I'll get to them in just a minute. I just want to do just very quickly to start the show. I mentioned, the title, money market accounts versus funds. This kind of came up because I got an email from someone asking about how frequently a money market fund compounds. So I thought I'd just maybe broaden that topic a little bit. So there are some sort of key differences between money market accounts and money market funds, although at the end of the day, I think they both kind of serve the similar purpose, and that is a very safe way to save, to invest cash. So a money market account you would get at a bank, and it's FDIC insured. It's, as a practical matter, no different than a savings account. Some MMAs, money market accounts, offer check writing, but it's basically an FDIC insured savings account. This is all as a practical matter. This is my site, All Cards. We track a lot of money market accounts. Make this a little bigger. How many do we have now? I don't know. Maybe 50? We could add more. And I just list them in order of the APY. So you'd want to dive into the details of each of these, although comparing APY factors in the compounding, so it allows you to compare apples to apples. But at least all of the money market accounts that I've seen and looked at the details, they compound daily. There could always be exceptions, so you're going to want to look at that. But you can see some of the rates. Now, with money market funds, they are not FDIC insured. They're a mutual fund, right? And they're offered through brokers. So you can get one at Vanguard or Schwab or Fidelity. And we can take a look at a couple. Let me just do Vanguard money market fund. Let's see what we get. We get, here it is. So I've got this one. I've got some money in VMFXX. You can see it's 7-day yield. Now, again, there could be exceptions to this. I don't know if it's regulated, but when I've seen it, they compound daily, they pay monthly. And this is the 7-day SEC yield, which is basically the income it produces over the last 7 days annualized. And if you actually click on, these are, here we go. Average annualized income dividend over the past 7 days. So that Vanguard's very helpful. And so I mentioned this is not FDIC insured, but what it invests in is extremely safe. It basically invests in this particular one, federal money market, government stuff. Let's see here. Did I go by it? Oh, here we go. So you got U.S. government obligations, U.S. Treasury bills, repurchase agreements. What those are, at least this is my understanding, and I'm sure some of you out there have more experience with repos than I do. But the idea is you effectively, you want to borrow money. One way to do it is to sell the lender something. I'm going to sell them a bunch of U.S. Treasury bonds. and they're going to give me some amount of money for it that is below their actual market value, typically. And then, but we'll agree that I can buy them back from them the next day or in a very short time period for a little bit more than they paid me. So, and that difference is effectively the interest rate that the lender's getting. But it's a very safe way for the lender to extend in effect credit, because they're taking this asset. They're not just, and it's not just collateral. They're actually owning it. They're buying it, and they're buying it at a good price. But of course, they're going to end up selling it back the next day, let's say. Anyway, the point is, this is all very, very safe. And in fact, the average duration on these kind of funds is like, well, here we go. Average maturity, 13 days. These are very, 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 very short-term funds. And, Schwab has them. We can look. Schwab's are a little more expensive than Fidelity, than Vanguard. Let's see. Schwab money market funds. Let's pull this up. I've looked at this. They have a bunch. If we look at their government treasury, here they are. Now, some of these have $1 million minimum investment. So for most folks, you'll be looking at the ones with zero, and you can see their rate, their yields are a little lower than Vanguard. Vanguard's again is 451. It's because of the expense ratio. This is 11 basis points. And if you look at these, let's just go to SNVXX, it's probably around 34. So not quite as cheap. I don't know about Fidelity in terms of expense ratio. Fidelity money market fund. I still probably prefer T-bills because of the tax break. Now, you might get tax breaks out of some of the interest on money market funds if they're federal government obligations, but then you got to figure it out. Anyway, let's see. Well, I own some of this, I believe. Let's take a look, see. Let's first look at fees. What are the fees? So fee 42 basis points. That ain't cheap. Particularly for a fund that's paying still relatively little. Now the summary, what's the 7-day yield? Why can't I find it? It's somewhere. Here we go. 422. Yeah. So I guess Vanguard's got the better deal right now. But again, it probably comes down to fees. Weighted average maturity of this one's just 9 days. So I think they're both reasonable options. A lot of times it comes down to where you have an account. If your money's at a broker and that's kind of where you want to keep it, money market fund is just convenient. If your money's sitting at a bank account, let's say a checking account, and you're wanting to move it to something that pays more interest, savings account or money market account is just, it's assuming they have good rates wherever you bank, it's right there. It's kind of easy. So, yeah. So there you go. That was quick. I think painless. For me, it was. Maybe it may not have been painless for you. By the way, I really need a haircut. Anyway, it's like it creeps up on me. It's like I think my hair is, it's fine, short. And then like I wake up one day and it's like, did it grow 1.5 inches overnight? What happened? I guess it's a good problem to have at my age anyway. All right. Enough chit chat. Let's get to your questions. Let's see. Why can't I see this question? It's funny how, I'll just show you this. So this is what I'm seeing. This is behind the scenes of this live stream. And you can see the top question here is covered up by the Ask Me Anything. It won't. And you'd think, now maybe, can I get rid of this? Maybe I can toggle it out, pop out. Let's do this. Maybe this will work. I don't know. I would just think the engineers at Google could figure this out, or maybe it's me. What? See, this is the top chat. So let's go to questions. Okay. See, it must be me. I'm the problem. not Google or YouTube. That sounds about right. So Ed says, "Go Bucks." Not a question, but I think I like Ed already because did you see Stroud did pretty well in the combine? Is that what they call it? I think so. He apparently threw the football 60 yards. I don't know. I guess that's a big deal. Can't all NFL and potential NFL quarterbacks throw the football 60 yards? Maybe they can't. I don't know. Okay. Stuart wants to know. Again, I can't pop these up on the screen. My good friend Jim is in the house, and he says my hair looks great. Well, that is so kind. Jim wrote a great article that I linked to in a, so he's over at Wallet Hacks. You ought to check his website out. I've known Jim for, I don't know, 15 years. So we've talked about the blue binder. Hang on. Oh, here's my blue binder. And we call it the blue binder because it's blue. But that's where, you know, if I get hit by a truck, hopefully I've kept it updated. My wife knows where all the Bitcoin is stored. I'm just kidding. I don't own any Bitcoin. But, you know, all of our accounts and whatnot. So Jim did one. What'd you call it? Treasure map, I think. Anyway, I linked to it in the weekly newsletter. Not this past Sunday, I don't think, the Sunday before. Which, by the way, if you haven't signed up for the newsletter, there's a link below the video. You can sign up for it. But anyway, always fun to see people in the chat that I actually know, you know, like in real life. All right, Stuart. Hey, Rob, what are your thoughts on the vehicle market in the U.S. now and in the future? Looking to buy a used truck, and I can't get over how ridiculous prices still seem to be. Yeah, I still kind of expect prices at some point to come down. I mean, people are getting the car debt market is taking on some water, and folks are getting, at least, you know, the news articles I read about this say that we could have a bit of a crisis at some point, folks not being able to make their car payments. And, you know, that could flood the market with cars potentially. But I confess, I'm not in the market for car. Now, I have watched Elon Musk lower the price of Teslas. This week, he lowered the S and the X by a lot. And of course, that has folks upset if they just bought one or if they already own one, because the used Teslas have come down in price significantly. But Stuart, I guess that doesn't help you. I will say that I almost bought a Model X in 2021, I think. And I ended up canceling the order because I got tired of Tesla promising a delivery and then not meeting that delivery. And I needed a car because we had a granddaughter. And boy, I'm glad I did, because, you know, then there were almost no X's on Tesla's website for used cars. And of course, they had the inventory. They were behind on delivering new cars. Today, if you go to their website, at least I've gone a couple of times in the last few weeks, they got a flood of cars available. So I'm still, Stuart, a little surprised that prices haven't come down, but I confess I've not been tracking the market closely. Mike wants to know, can we keep doing these Q&As on Tuesday? Much better than Mondays. All right. Well, you know what that means, don't you? Hang on. Well, how do I do this? See, once again, here we go. Going to go to the chat. Going to ask a question, start a poll. Monday or Tuesday? Yeah, I'll ask a different question. When should we do the live chat? Now keep in mind that at the end of the day, I kind of decide this. But, you know, I don't mind asking you guys. I'll throw in Wednesday and Thursday just because. But obviously, Friday and the weekend are out. There you go. All right, going back to the questions. Here we go. Dave wants to know, how's your chess game going? Not bad, actually. I mean, I haven't played any rated tournaments. I was going to play in New Jersey, and I couldn't, helping a family member. I've been playing a decent amount of speed chess. Played a game before the live show started, as I always do, and I won, so I got that going for me. I had my rating at like 2030 on chess.com for 3-minute speed, and then today I had a bad day, and it just torpedoed into the 1800s. But overall, not bad. All right, Mike Rogers wants to know, with T-bills hitting 5%, would you allocate part of your bond fund there or your emergency fund? Absolutely, on an emergency fund. I like T-bills a lot, and that's basically where we have ours. Again, you could find a savings account or a CD or money market that's going to pay something comparable. And some people are just more comfortable like having their money in a bank account. I get that. But I do like T-bills. In terms of the bond portion of your asset allocation, I get a little nervous about changing the duration of my bond allocation, because I get concerned that I'm just chasing interest rates in a way that may make sense when I pull the trigger to do that, but then at some point it's going to change, and if I don't get the timing right, I could lose out. They say if eventually, of course, we heard Powell today, it sounds like rates are going to be going up more, but at some point they might come down. So I don't tend to, personally, I don't change the duration of my bond portfolio, for asset allocation purposes. But I definitely use T-bills for emergencies. I think you can, particularly if you're, say, retired, and you want some of your bond portfolio with shorter term. I don't see anything wrong with that. And I know Bill Bengen did a paper, I want to say it was his 96 or 97 paper, but it, I guess, doesn't really matter. This was after the 4% rule paper, which was 94, where he said you can put up to 10%, I think it was, in like T-bills of your overall portfolio, which would be a subset of your bond portfolio, right? And not really affect safe withdrawal rates, for what that's worth. Again, he's using, at that point, historical, I think all U.S. data. At some point, some of his research looked at, some international stuff or small cap. Or maybe he didn't actually go to international. I know he wanted to at one point, didn't have the data. In any event, that's just a data point, for what it's worth. Michael says, if you were responsible for your mom's possible long-term care needs, how much money would you set aside? Genworth says nursing home care in New York averages $159,000 a year. I've set aside $650,000. Enough? ? Oh boy, that's a tough one. So you've basically, in today's dollars, set aside enough for what? 4 years, thereabouts. You could look at studies that tell you the average time someone needs to be in a nursing home, but that's not going to, I don't know what good that's going to do you, right? My guess is that number would be under 4 years. I've seen that data before, but I could be wrong about that. But of course, it's like saying, the average person has, family has 2.3 kids. I'm pretty sure none of you have 2.3 kids. And so, you could use a study like that. But, you don't know what the reality is going to be for your mom. I think I will say, just stepping back from it, setting aside $650,000 today, which presumably you're going to invest and it's going to hopefully grow. Doesn't sound like your mom needs care right now, is phenomenal. But I don't know how to answer that question, or even to point you in the right direction. I guess one question would be, should your mom get long-term care insurance, perhaps that you pay for? That's something to at least consider. But keep in mind there are limitations on how much they pay per day or month, and for how long, and when you qualify for it. Long-term care insurance is kind of a mixed bag as far as I'm concerned, but it might be something that you want to consider. But I don't know that I'm trying to think of a smart thing to say in answer to your question, and I'm coming up empty. But I don't know, 650, that sounds like a pretty good chunk of change to me. The other thing too, if you think about it, is there's a range of care that someone might need, right? So they might not go from not needing any care to a nursing home. They might go to not needing any care to living perhaps with you with some assistance, or living on their own with some assistance. So it's not necessarily, no assistance needed, and then all of a sudden in a nursing home. I guess that can't happen, obviously, but so there's a lot of different, kind of ways that could play out. Still, I don't know how helpful that was. John wants to know, John's asked a question I can answer. What's your chess rating? Thanks for good content. So my over-the-board USCF rating's like 1900. I was almost at 2000, and then I had like 2 really bad chess tournaments, and I went into the 1800s. Yeah. Okay. G. Branding is moving to a low zero income tax state in retirement all about the fact that you've loaded up on traditional IRA and you're saving on the income taxes as you withdraw the retirement accounts? Well, from a financial perspective, it would be traditional accounts, traditional retirement accounts. There could be other income too that you might have in retirement that could be subject to state income tax, but that's probably the biggest one. From a taxable account, you've got capital gains, so you'd have to understand how state taxes that. There's also just the question of the cost of living, right? But yeah, that's a big consideration for a lot of folks, particularly if you're coming from like a New York or California that has very, very high income taxes. And by the way, software like New Retirement will model all that for you. Like you can put in there, I'm going to move to this state, and it models all the tax stuff for you. So, Dave, your thoughts on Fed Chair Powell's testimony today? So I didn't hear it. I read about it. I understand that he said that rates are likely going to have to go higher than folks expected. So my overall sense of Powell is that there's a psychological element to inflation, something that Arthur Burns in the 70s, yeah, kind of realized maybe a little too late. And he's actually, I assume he's passed away now, although I don't know that. I shouldn't say that about someone unless I know for sure. In any event, he sort of acknowledged this and talked about it in some speeches, I think in 79. But once people expect inflation to be high, they act accordingly, and which can cause inflation to go up higher. So you can sort of get into this vicious cycle. And so one of the jobs of the Fed chair is to deal not only with the numbers, but the psychology. And I think the way he's dealing with the psychology is he's sort of like the lighthouse. He ain't moving. He ain't budging. And what he's saying is, the pain will continue and will inflict even more pain until inflation is whipped, right? Anyone know that reference? You're old like me if you do. Whip inflation now, something like that. Anyway, and he has to do that. I think it's the absolute right thing. Now, politically, we could really hammer inflation quickly but we won't, but we could. How? Raise taxes, and it couldn't just be on the rich. It would have to be on the middle class. And then say use it to pay down the debt. In other words, don't funnel it back into the economy in some way. Pull it out of the economy and keep it out of the economy. That's how you take care of inflation. But politically, it's probably not possible, at least right now. Kat wants to know my thoughts on Social Security solvency and implications for retirees. So, of course, the big question is, I don't think the question is, will Social Security go away? I think the question is, will benefits get cut? And if so, when and how? Will they simply be reduced for everyone? Will there be some sort of means testing? more likely, in my view, but who knows, will they raise the full retirement age, which to me seems like the most sensible thing to do. And it seems to me it should be raised as we live longer. Now, you wouldn't raise it on someone who's just about to collect. You'd give folks, I don't know how far back you'd go, but and that's kind of what they've done now. Not everyone, the full retirement age today depends on when you were born. But that seems to me to be the thing to do, but who knows what will happen. By the way, that's the thing that's got everyone all up in arms in France, right? I think they want to raise retirement from 62 to 64, I think, like something like that, and they're flipping cards over. So I get it. This is a big issue. But something like that's going to happen. To me, that's really the question. Of course, we can always try to raise taxes. And I know that was what President Biden proposed today, not for Social Security, but for Medicare. I personally think if we're going to raise taxes, and maybe we should, it should go to the deficit and the debt, not for extending more spending. But to answer your question, Kat, I think it's likely that something will change. How it will affect an individual is going to depend on how old they are now, exactly what the change is. If you're close to retiring, it may not affect you at all. Or if you're I think if you're in retirement, I'd be surprised if it affected you. I guess anything's possible. I just don't see that, just politically. By the way, did you see that we're almost at 90,000 subscribers to the channel? At 100,000, I get a plaque that I'll put back here, and I guess I'm pretty excited about that. I gotta be honest. All right, Patrick, Robert, when you say we about your website, do you have a team of people keeping the site updated? I do. So I have robberger.com. Basically, no one works on that. I have big plans for that site, but I don't really have help on it. But for all cards, yeah, I mean, we're tracking like 600 or 700 certificates of deposit, hundreds of savings accounts, money market accounts, checking accounts, hundreds of credit cards. So I have a team of 3 people that do a lot of work keeping that updated. Yep. I do want to add, by the way, money market funds as a separate category. And I'm going to be doing that soon. I'll let you know when I do. It's interesting in the world. I'll just deviate for a second. In the world of making money online, which I've been in that business since 2007. Yeah. And my views of it have changed over. I've learned a lot. My approach has changed. There's a lot of things that I do on allcards.com that make money or could. And there's a lot of things I do that don't make money, and it probably never will. So for example, we track hundreds and hundreds of savings accounts. Only a few of them are what they would call affiliate relationships, where if someone clicks on the link and opens an account, I get a fee. Most of them, the vast majority, I don't know if it's 90, 95%, aren't affiliate offers. And so you have as a website owner, you have a choice. You have a decision to make. So what a lot of sites do, in fact, pretty much all the big sites, when you go to their best savings account page, you're primarily only getting their advertisers. Now, some of those advertisers could have great savings accounts, right? But there could be other great savings accounts out there that you're never going to see, at least on that site, because they're just not going to show them to you. And I get it. I mean, they're trying to run a business, and Home Depot doesn't sell every single hammer that's ever made. They only sell the ones they think people are going to buy and they can make good money from. So, that's fine. What I decided with all cards was we were going to try to track as many accounts and credit cards as we can. We're still working on it. It's still a work in progress. And so from a business perspective, my long-term thinking is eventually people will come to appreciate that we're showing you everything. And the bank accounts are easy because I just list them in order of the interest rate, right? And if the top offer happens to be one that is an advertiser, great. And if it's not, well, it's okay too. Anyway, I don't know why I went into all that. You guys don't care. Why should you? Kat says, how should we think about the probability of success when using programs like Personal Capital? 98% success means what? Where should we want to be? That's a great question. And it's really Monte Carlo analysis, right? Because that's what Personal Capital uses. On Trajectory, which I've been playing with, it uses. New Retirement uses it. Maxify, which I did a video on a while back, uses it. And so the first thing I would say is there's a number of things. I don't look at it as we'll use your 98% as success versus failure. 98% chance of success, 2% chance of failure. The way I think about it is, what is the chance that I'm going to have to modify my plan at some point because it's not working, right? Because I don't think any of us are going to just spend down to our last dollar. It didn't work. Wow, look at that. I'm broke, right? We're going to make changes. And so the other thing is when you think of it that way, I think you see the number a little differently. Because if it truly is, success or failure, you're going to want that number up pretty high. So for me, I don't have sort of a line in the sand where it's got to be X number. I mean, I've heard some say, look, shoot for 90, others shoot for 80. I don't know that I've heard less than 80, maybe 75%. But here's the thing that's hard to figure out with a lot of these programs. Actually, you know what I can do? I can show you an example of this. Maybe. I think so. The point I want to make here is that not all Monte Carlo analysis is treated equal. There are inputs that go into the Monte Carlo analysis. So, for example, you could say, okay, for stocks, we're going to assume an average return of 10% and a standard deviation of 18%, let's say. And that's going to then feed into the Monte Carlo analysis when it comes up with its 500 or 1,000 or 10,000 different scenarios. And the same thing with bonds and so on. What gets put in there affects the outcome. So, for example, I hope this makes sense, and I'll show you with new retirement. If I were going to use an input, let's say based on historical data over the last 100 years, mainly U.S. stocks and bonds, where we know things went pretty well for us as a country, and stocks did really well. And I think to myself, I'm going to use that, but we don't know that the future is going to be so kind to us. Well, I might want a higher success rate, right? Because I'm using sort of rosy assumptions going into the Monte Carlo analysis. On the other hand, if I said, well, let's not assume 10%, let's just assume 6% and something lower, then I might be okay with an 80% chance of success or 75. Again, I think it's hard to say exact numbers. Assume this, and this is the percent that makes sense. It's more of just understanding the relationship between the inputs on the one hand, what comes out on the other, and looking at the chance of success that way. The other thing I would do is run a number of different scenarios, right, with this software. I wouldn't just run one. To see how different assumptions, it could be doing Roth conversions, it could be, both live into 100 if you have a significant other, or one passing away early, and all these different things to see how it's affecting everything. And so you're going to get sort of a general feel for it. It's not going to come down to a single number in any event. So let's see if I can show you this. So this is all made up data. This is new retirement. Let's see. So this says, so here we go. This is 99%. It doesn't matter what the inputs are. Although I think it's it's a $1.4 million portfolio, but in any event, that doesn't matter, 99%. But if you look at the assumptions that I've made here, what new retirement allows you to do is assume optimistic, which would be, if we go into the accounts and we go into savings, and let's look at this one. You put in the optimistic number right here. I don't know if you can see that. I know it's small. I've got 8% in there. Pessimistic I've got is 3.75, right? Okay, go back to overview, go back here. So I can pick my the big number that I put here, let's do that. And some things changed. It's still at 99%. This is the average between my optimistic and my pessimistic, still 99%. But let's now look at pessimistic. Okay, now I just torpedoed to under 15%. So again, the point being that the inputs that go into this affect the percent. Now, if I were doing this and this were actually my plan, I'd be drilling down into this to understand why there was such a dramatic difference. It could have been because I was just throwing in numbers. This is all made up data, so who knows what I put in here. But again, I think it does a nice job of showing you how the assumptions affect the outcome for Monte Carlo analysis. Hope this makes sense. By the way, I also have max spending set. So if I did spending needs, still under 15%. So who knows why? But I don't know. I hope that helps. Sometimes I feel like it's like blah, 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 blah. And it's like, I don't know if that was helpful. Hopefully it was. Then she wants to know thoughts on Macquarie's bond versus stock analysis. I have no idea what that is. I probably should, but I don't. But if you ask again and tell me what that is, should I know that? I don't know. Jimmy Boy says, by the way, from folks in the South, and my family, father was from the North, mom was from the South. It was always the name and boy, Lou Boy, Kenny Boy. So this is Jimmy Boy. Let's see here. I'm 28-year-old public auditor. That ain't an easy job. I know as a former enforcement attorney at the Public Accounting Oversight Board, Public Company Accounting Oversight Board. Ain't an easy job. Hours are crazy and I want to make more. I'm a great test taker. So considering CFA, GMAT, LSAT in that order to switch careers, thoughts? Oh my word. Well, those are just so many different things. So if you wanted to become, I guess it depends what you want to do. You mentioned CFA, but it really depends on what it is you want to do, because maybe you want to become a certified financial planner. But, I think working in this industry can be great. Depends how you do it and what your goals are. For the GMAT, I don't know, that could be anything, right? So I don't know what your thoughts are behind that. LSAT, well, I was a lawyer. I don't regret being a lawyer. I think the path that I took was not an easy one. I enjoyed it for the most part, but it's not an easy one. And by that, I mean going to like a top 25 law school, graduating, in the top part of the class, getting a job at like a top 25 law firm, making good money and working 70 hours a week. So you're talking about now you're working crazy hours. Now that's not the only path for a lawyer, of course, but if you're wanting to make more money, that's certainly a way to do it. It's not an easy way to do it. If I had to do it all over again, I wouldn't have gone to law school. Again, that's not because I didn't have a good experience. It's just that I think there are more interesting things to do, but that's just me. So there you go. I don't know how helpful that was. That's my take on it. Dave wants to know if I'm a Buckeye basketball fan too. Not really, actually. I don't watch Ohio State basketball. Maybe it's because they're not any good. I don't know. Maybe this year they are. The last time they were good, they lost to Florida, I think, in the final, right? Didn't they lose to Florida in the football final as well? And maybe did they lose in the soccer final? I don't know. We were like runner-up in everything that year. What year was that? I'm going to guess. This is a guess. 2005? I don't know. We had what's his face who went to Portland, I think, and got injured. What was his name? Great basketball player. It's the reason we made it as far as we did that year. Now his name escapes me. Okay. Sergio wants to know, does it make sense to keep volatile investments in taxable accounts to provide tax loss harvesting opportunities? I personally hate foreign investments because I don't think they do well. Well, let's first talk about that. It's certainly true that international funds, index funds, for example, have for the most part not done well in the recent past. I think, though, I don't think I'm still invested in international stocks, and I think time will come when that changes. Now, what the next 50 years look like, I have no idea, but that's just my view. I hadn't thought about putting more volatile investments in a taxable account for the tax loss harvesting. I think of it a little differently. I think of it in terms of tax efficiency, which often would mean putting volatile assets like stocks, right? Because, you get, say, a total stock market index fund. It's a pretty efficient, tax efficient fund to have. It's paying a fairly low dividend yield. What is it, 1.2 or something like that? It also depends how you're investing. Like if you've got like a lump sum in there, I guess it depends if you're continuing to contribute. Because what I found is, unless you're continuing to contribute, maybe you are, your tax loss harvesting opportunities will eventually go away. And that's happened. That's basically where I am. I guess anything can happen, but boy, the market would have to really tank for me to have tax loss harvesting opportunity. Of course, I should knock on wood. I don't know. Maybe I've just jinxed us. I think, I'm not saying that's a bad idea. I think more in terms of tax efficiency overall than I do specifically tax loss harvesting. Rick says the 5-year CD rate. Oh, by the way, let me go back to the poll. We'll go here. I got to flip around here. This is. So 48% still want Monday. So you guys win. Works for me. That was easy. I need another question to ask you guys. But at the moment, I'm going to go back to your questions. Okay, where was I? John makes a good point. Monday does not necessarily win in the poll. Any day other than Monday is the true winner. Well, now you want to poll with just 2 choices. Oh my, you got, okay, fine. Monday or Tuesday. And I should put the choices as like Wednesday and Friday. It's not really even funny. Okay, there you go. Omar says Tebow could not throw 30 yards. Well, he's no longer in the NFL. Although he had a decent year for Denver, didn't he? Anyway. The Tabby says, not really a question, but your Facebook stream, because this is streamed to YouTube, Facebook, I think Twitter, and LinkedIn, is only a second or 2 behind this one on my end. I'm impressed. Well, you can thank Restream. That's the tool that I use. All right. What are your thoughts on VTEB for 1.5 years to park money? We've looked at that before. Let me, I don't remember the duration of that. So it's a tax-exempt bond fund. Here it is. The question, when you want to park money for, like in this case, you said 6 months, is duration. It's got to be intermediate. Yeah. So you could lose money. If I wanted to park, and what I mean by that is if rates continue to go up, the value of the fund, this fund will go down, right? If I needed money 6 months from now, I think I would just do a 6-month T-bill. Would be my choice. But that's just me. Now since you mentioned a tax exempt bond fund, obviously that tells me taxes are an issue, and a T-bill, while it doesn't have state income tax, is going to have federal. So you might find a shorter term. I don't know if you find a shorter term tax exempt fund. They might be out there. I don't know. Rick says the 5-year CD rate of 5.25% through Fidelity seems like a great CD rate and much higher than on Bankrate or TD Ameritrade. I plan to move some funds from my stable value fund in the 401k. All right. I don't remember. I know we track that on all cards. I don't know what the term is. Oh, 5-year. 5-year. Yeah, I mean, it depends what rates do, right? It strikes me as a reasonable bet, though. Although I don't tend to make that kind of bet. I could see rates going up, but you would think over the next 5 years they'll end up being lower. Anyway. Okay. Noreen says, recent news, a Wells Fargo customer lost $24,500 from his account due to a fraudulent ACH transfer. Can you discuss keeping your money safe in savings and checking accounts? Well, that's a great question. I guess I don't know the circumstances behind how that happened. I think generally, what I try to do is use complicated passwords, use two-factor authentication. Where I can, use an app for the two-factor authentication rather than a text message. I also have, but haven't used yet, the YubiKey, right? So this would be like, it's a hardware implementation of effectively two-factor authentication. And this can work with an iPhone or a computer. It's got, I don't know, you probably can't see that. It's got two different connections. One's for the iPhone. I can see that's not focusing very well. How about if I do this? No. There we go. I guess if I just bring it out to me anyway. Of course, it doesn't do you any good if you just keep it in the package. And then keeping an eye on your accounts regularly. I get a notification, drives my wife crazy. Basically, whenever she spends money, I get a text message. Oh, I find that funny. She doesn't always find that funny. But keeping an eye on it. I'm sure there are other good things that folks in the chat can add to it, but to me, those are, big things. I have to look up this thing with Wells Fargo, though. I don't know what happened there. Be curious to know, the specifics of that. All right. By the way, I'll keep the poll up there for a little bit longer, but I see Monday is winning at 55%. So this is a very divided crowd. I mean, it's winning. Dale wants to know, is a professional required to perform a mega backdoor Roth conversion? A professional. I'm not sure what you mean by that. Like, do you need an advisor? You say someone at income of 200,000 and already maxing Roth 401k HSA. I don't know what you mean by that. I mean, you don't need an advisor. I mean, and you could probably, if you wanted help, work with either your 401k administrator or wherever you're going to end up doing the backdoor Roth, and they could probably help you walk through it. Again, I've never done one because I've never worked at a place that had a 401k that allowed me to, which is very sad. So JRLVND asks, is there a long-term U.S. Treasury rate that if it hit, you would sell your BND and buy U.S. bonds? Example, 10-year hits 10%. I don't know. I mean, if the 10-year hit 10%, BND would be high too, right? I can just tell you this from experience. I was investing in 6-month CDs in 1982, making 16%. And of course, even with the increase in rates here recently, 16% is still crazy, right? And I think a fair question would be, well, Rob, why did you stick with 6 months? I mean, why not lock in for 5 years? Or why not buy a 30-year US government bond? Were they callable then? I think they were, in any event. And the answer is we were scared to death rates were going to go up. And so, when you're living in we'll call it a 5% yield environment, 10% just seems fantastic. But when you're living in a 10% environment, 10% no longer feels fantastic. It just is what it is. And you start to think, well, our rate's only going to go up, which is, by the way, is exactly what we're doing now. We're in a 5% yield environment. Our rate's just going to go up. Of course, we had Powell basically say, yes, they are. And so it's easy in a 5% environment to say, yeah, I'd love to lock in at 10 or whatever percent. But once we get there, that decision is not nearly as easy as it sounds today. So I don't know that I would, actually. I'm sure there's some rate, maybe, or some set of circumstances. But yeah, living through it's a lot different than just thinking about it. You know what I mean? Okay, Dave wants to know, have you had any issues with personal capital since they changed to Empower? I have not. My account states it is no longer valid to contact support. I can look into that. Let me pull it up, see if I can log in. So this again is a demo account that I have telling me that personal capital is now Empower. By the way, for those that didn't know this, Empower bought personal capital actually a year or two ago, and they've just rebranded all. It's the same tool. I don't think they made any changes to the tool, at least that I know of. Help. That's a bot. Let me just see something real quick. This is their help. Submit a request. I don't know. It allows you to submit a request. Let me go back to your question for a second. You're no longer valid to contact support. Well, you can you've emailed no response. So I guess the question would be, how long ago did you email them? But what I will do is reach out to my contact there and see if there's been any changes or what's going on. Aaron says, I'm 32. I have a mandatory retirement age of 56. I'll have a Fed pension and Social Security supplement until 62. And then I guess you have Social Security after that. Anyway, I'm currently saving 28% of my income with 175,000 saved so far. Am I saving too much? Well, first of all, I guess in theory, someone could save too much. I suppose if you were making big sacrifices, there were certain things you wanted to do today, but you were denying yourself trying to save. What I would recommend is that you just put your numbers into a simple tool. You could use Empower personal capital. It's free, and they have a decent retirement calculator or planner. It's not the most robust, but actually, I think it's ideal for someone in your situation because you're years away from retirement. It can do the projections for you, but you don't have to use that. You could do this in new retirement is another one, and it will help you see what your finances will look like. You're talking now another 20, almost 25 years from now when you're 56. So, that's what I would do. The other question I would have for you is, if you didn't save 28%, what would you be doing with the money? Is there any chance you might want to retire early? Maybe you don't. Maybe financially it makes sense, I'm guessing you work for the government, to work until your retirement age. Maybe that just makes sense financially with all of the different pensions and other things that you have. And maybe, I don't know, maybe you get some good health benefits if you work until that age as well. I know some folks that have excellent health benefits in retirement from their work with the federal government. I think some of that's changed over the years. It's probably not as good today as it used to be, but it could still be quite good. So there's sort of a lot of factors there, but you could just use a simple tool, like I said, personal capital or new retirement. There are others, but that can show you, do projections. Now it's going to have to make some assumptions about inflation and market returns, and you can maybe put in you can test out different scenarios. It'll give you an idea of how much money you'll have then and how much income that will support. And you can answer that question for yourself. That's what I would do. Maybe I'll do a show. Maybe I'll do a video on sort of how to project, how to know how much you should save early in your career. That's actually not a bad idea. Well, I don't think it's a bad idea. I don't know if you guys like it. I'm going to take a note. What do I got here? It's a tax document. I won't write on that. I'll put together a video on that. And maybe I'll find some other tools beyond the two I've mentioned that might be particularly good for that. Yeah. Okay. So Roy asked, Rob, I never get a question read, but here we go again. Ooh, I hope it's a good one. Rob, will CDs possibly hit 6% within 2 months? I only laugh because I don't know. If I had to guess, let's see what the top CD is right now, at least according to allcards.com. We don't list every CD, so I'm sure there are other good ones that we don't have. By the way, many of you email me when you find a great rate, and please do. If we don't cover it, I forward the email to my team and they add it. So yeah, so this particular page. So if you look over here, you have different terms and no penalty as well. But if you just click this one, it basically does a total data dump of every CD we have. You can see we track at the moment 765 of them, all of different terms, right? So this is everything, and we're at 5 1/4. Those are all Fidelity, Western Alliance, which is a Save Better option, which this is an advertiser. Fidelity's not. I ought to call up Fidelity. Anyway, 5.01, and there's others here. 5% seems to be the high water mark for the most part, right? So, we certainly could get to 6% in 2 months. I'd say it's possible. A lot of it depends what the Fed does. But I would, if I were guessing, if I were making a 50-50 bet, my answer would be no. We will not be at 6% by middle of May or first week of May. That's my, and you guys can hold me to it. Someone remind me of this 2 months from now. I'm going to guess we will not be at 60%. Now, remember, Monday was at 55%. Now it's at 60%, so it's gaining ground. Man App wants to know, what is the difference between money market accounts and money market funds? I'm guessing you came to the show a little late. I covered it at the beginning, and you'll be able to replay this video. I don't know if you can replay it while it's live. You might have to wait for me to shut up and hit the stop button, which will happen in 32 minutes, and then you can see. Conscience wants to know, do you have any opinion on buying interest points versus a bigger down payment? So you can buy down the rate, right? Of course, a bigger down payment might also potentially lower your rate. Some, depends. So that's something to consider. I've got to believe a big part of that question will hinge on how long you're going to have that mortgage, right? Because when you spend money to lower the interest rate on your mortgage, it's going to be a certain amount of time sort of before you break even, right? I don't know what that is. There's probably calculators that will do that for you if you Google it. And so a big part of that question, I think, is going to be how long you're going to be in the mortgage. You can figure out the break-even point. You'd have to factor in tax consequences if you're itemizing. I think that's how I would think about it. I'd want to know, will the bigger down payment lower my interest rate at all? If I pay down with points, how long do I have to stay in the mortgage to break even on that? Factoring in tax consequences. I think that's how I would think through it. I think so. Al said, I found FDLXX instead of SPAXX, which is the Fidelity fund we looked at earlier. Is it a good idea? FDLXX. Well, let's take a look-see. We'll go to Morningstar. Here we are. FDLXX. First Trust, Morningstar Dividend Leaders ETF. Let me just make sure I've got the right ticker. FDLXX. Yes, I do. No, this is not FDLXX. Try that again. FDLXX. Okay. It's not unusual for Morningstar not to cover a money market fund. Oh, so this is okay. So this is Fidelity's treasury only money market fund. Kind of expensive, 42 basis points. Its yield is 4.16. And I guess you wouldn't pay state income tax on this, or maybe you'd pay a little. I don't know what this 5.98% is. It seems like a reasonably good fund. Its yield isn't as good as the Vanguard fund, but of course you may have all your money at Fidelity, and that's fine. But the SPAXX, let's see here. I'll pull that up on Fidelity. I don't remember the yield. We just looked at it, but it's 4.22. I think these are both reasonable options. That's my take on it. Kat says, Rob, in your Sunday newsletter, you published an article from Verdad. Yes, I remember it well. Do stocks always outperform bonds? And that's the Macquarie reference. Yeah, I just didn't get that in your question. But I do remember the updating and extending Jeremy Siegel's analysis. I would have to go back to that article and reread it to have any opinion on it. I just don't remember it well enough. I remember liking the article a lot, but I just didn't super focus on that. So he extended Jeremy Siegel's analysis, which showed that stocks don't always do what we think they're going to do. But I just, it's like I read all this stuff, I put the newsletter together, I send it out, and then it's gone. It's short-term memory. I don't know. I'll go back and reread it, Kat. Maybe I can talk about it in 2 weeks. Okay. With rates likely to go up soon, does it make sense to sell intermediate muni bond mutual funds now and leave those funds in Fidelity's 4% money market cash account? Well, again, what you're kind of asking me is the future of interest rates. And I know I sound like a broken record. It's just not how I invest. I still have BND, which is not a muni bond fund, but it's an intermediate term bond fund. I don't have any plans to sell it. Excuse me. I'm not saying that if you did that, it wouldn't work out great for you. Like, it's a timing question. It's just not how I do it. So Man Amp wants to know the difference between buying a CD from a bank and a CD from Schwab or Fidelity. We've talked a bit about this, not today, but in past videos. So the big difference is that when you buy from a bank, if you want to cash in early, then you terminate the CD. There could be a penalty, right, associated with doing that, an early withdrawal penalty, and then the bank gives you your money back, right? Now let's instead say you bought a brokered CD from, say, Fidelity, and you want to get out of it early. You don't sell it back to the bank. You didn't buy it from the bank. You don't sell it back to Fidelity. You sell it to another investor. And I think Fidelity, I've never done this, but I think they have a way to do that on their site. And you won't pay an early withdrawal penalty. But if interest rates have gone up since you bought, you're going to have to sell it at a discount. Or why else would anyone buy it? You've got a 5% CD and you want to sell it when rates are 6%. Why would someone buy why would they pay full price for a 5% CD when they can go get a 6% CD? So in that sense, brokered CDs, the value of the CD itself fluctuates with interest changes in interest rates, just like a bond does. And you might say, well, I can just hold it to maturity. Well, that's true. Yep. And that's true with a bank CD, right? So yeah, Fidelity's, and I don't know about Schwab, but yeah, their CD rates are pretty good. So here's a great question. Advice to someone investing at 18 years old, how should they approach investing? So the way I would approach it, if I were 18 today, which is kind of hard to imagine, but I would probably invest the way I do now. I would start, I would think about a couple of questions. First is, what type of account am I opening up? Is it a 401k at work? Is it an IRA? Is it a taxable account? If I'm saving for retirement and I have a job with a 401k, particularly if they match contributions, that's the account I'm going to open. Otherwise, I'd probably open a Roth IRA unless my income put me in the top tax brackets. At 18, for most people, that would not be the case. Which kind of account you want to open? That's sort of question one. And then I would keep it simple. Index funds, low-cost index funds. I would tilt the portfolio towards stocks. Probably for me, it would be putting 90% in like a total U.S. stock market, or maybe even something like VT, Vanguard fund that invests globally. Or in my case, I like to control how much international stocks I have. So I might use a fund like VTI, which is Vanguard's total U.S. stock fund, and VXUS, which is Vanguard's international fund. And in some proportion, I'd put 90% in those two funds. That might be 60% in the U.S. and 30% in international, or maybe 70-20, something like that. And then I put 10% in a bond fund. Some will say at 18, that's silly, Rob, put everything in stocks. I can't argue with that approach. It's probably not the approach I would take, but I certainly can't say that it's a bad one. And that's what I would do. And I'd keep adding to it every paycheck. There you go. Now, there are other things to think about. Do you have debt? Do you have other goals? You're saving for, I don't know, to buy a home, you're saving to buy a car. There are other things to think about, but in terms of just the investing, that's pretty much it. It's pretty straightforward. And, you're going to learn the great thing about starting when you're 18. You're probably, I didn't start when I was 18, but I started when I was 20. I don't know. I guess I was out of law school, so I was 25 or something. But I was still nervous. It's like I didn't know what I was doing. I remember looking, of course, this wasn't online. It was a piece of paper, and it had all of the funds in the firm's 401k. And they're like 1 year, 3 year, 5 year, and since inception performance. And I'm basically going down just picking, I'm going to pick the highest one. What do I know? But I just kept learning, and I kept reading and talking to people. And it was great because to the extent I made mistakes, I didn't make major mistakes, but to the extent I made mistakes, I was making mistakes with relatively little money. And then once I got to the point where I had a little more money to invest, I had more confidence. I didn't know it all, but I, at least felt like, okay, I've got some idea of what's going on. I think the hard part is for, particularly say you've got a couple and one person runs the money and the other one doesn't want anything to do with it. And then the one that handles the money passes away. And so if someone now, they're in their 40s, their 50s, their 60s, their 70s, and for the first time in their life, they've got to invest or they've got to deal with this chunk of money. That's tough. Now, it can be done. I get emails from folks all the time who say, I'm thinking of one email from a woman who said, my husband died a couple of years ago. I didn't know anything about investing. I've been reading. I've been doing all this thing. I've been teaching myself. I feel more comfortable. And sounds like she's doing great. Not everyone's going to feel that comfortable doing all of that at that point in their life. So if you can start when you're 18, I think that's fantastic. Yeah. Okay. How are we doing on time? 8:10. So Rick wants to know any update on future guests. So it's funny you asked that. The short answer is no, but kind of. I'd been holding off. So there's a number of folks that are going to come on the show. Mike Piper, who's got open Social Security, great guy. I've known Mike. I met him through blogging, so I don't know, 10, 12 years. He was at the Bogleheads conference. Jonathan Guyton of Guyton Klinger, he reached out to me, and I owe him an email, but he's going to come on the show. I'm going to reach out to Wade Fowl. I'm pretty sure I've interviewed him in the past. And I was reading, he's got this RISA thing. I want to talk to him about annuities specifically, but he has this thing called RISA Profile, your retirement income style awareness. So I've really been working on my next book, which is about how to invest your money in retirement, near and in retirement. That's what the book is about. It's basically going to try to answer 3 questions. How much money can we spend each year without going broke? How should we actually invest our money? Like asset allocation, do we focus on dividends? Do we use a bucket strategy? All those sorts of questions. And then once we figured that out, the third question is, how do we actually create the paycheck? How do we actually pull money out from these investments that we've got, which factors in rebalancing, among other things. In any event, Dr. Fowl's done a lot of work on this. This is his website. I'm actually going to do this, where you answer these questions and it tells you your retirement income style, if you will. I think it's like $30 to do it. I'll report back. I'll do a video on it. But this is something that is very useful. I really like what he's done here, although I don't know that I agree with all of his approaches. But in any event, the styles, by the way, really what they are is what he calls probability based, which is where you've got your investments and you invest them with or without an advisor. And then you have some withdrawal strategy, and it's probability based because there's no guarantees, right? So you're sort of coming up with an approach that you think will work. Maybe you've done your Monte Carlo analysis and it's 85%, but again, it's a probability, right? Even if you use the 4% rule, it may not work in the future. So it's probability based. And then the other one is safety first. So that would be you take all your money and you buy an annuity. Those are sort of the 2 extremes. There's a number of in-between things. But what he thinks is that a lot of figuring out the right answer for you is based on your own personality, your own beliefs, your own fears. And this test that you take, which as I said, I haven't taken it, but I'm going to, will tell you where in one of 4 quadrants you fit. So I'll show you all that. But anyway, I'm going to have Wade Fowl on the show. The reason I've been holding off is because of all these things that I've been sort of dealing with, helping a family member. And I wasn't sure, like I didn't want to schedule it and then have to cancel and all this stuff. So, but I think I'm in a place now where I can reach out to them. And I even thought today I'm going to reach out to everyone tomorrow and see if I can schedule it. So it will happen. Oh, did I show you this? I don't know if I did. There it is. I don't know if I put it on the screen, but there it is. RISA, Retirement Income Style Awareness. He actually did a paper that I was just reading. In fact, I finished it this morning on this RISA and kind of walks through how they came up with the questions that they use on the test. I'll show it to you. If I can find it, let's see. Here it is. It's a 2021 paper. I marked it all up. But if you want to, like, if you're the kind of person that wants to dive into the details, here it is. You can just Google this, a model approach to selecting a personalized retirement income strategy. It gives you his sort of background on it. Okay. Where was I? So yes, the guests, they are coming. Here we go. Patrick plans to retire shortly at age 55. Congratulations. Oh, by the way, Monday is still winning at 57%. I wonder if the Tuesday people are calling up friends and saying, look, get on YouTube, get on this stream. You don't have to listen to the guy. I just need you to get on there and vote. Okay. Plan to retire shortly at 55, have 45% in, I guess it's 1 to 5 year treasuries, 25% in VU, that S&P 500, 20% in Apple. All right. Oh, and NVIDIA. Okay. 10% in VXUS, International Fund. Interest income from treasuries covers expenses. Well, that's pretty nice. Plan to wind down stocks into VU and VXUS. Reasonable or risky? Now, how in the world am I supposed to answer that? First of all, if you can cover all of your expenses based on the interest from treasury bonds, I guess, bills and bonds, and you only have 45% of your nest egg in those treasuries that's generating the interest that's enough for you to live on, that by itself seems pretty good to me. Now, if you then move the rest into VU and VXUS in some proportion, if I'm understanding your question, that means you're going to have 55% in stocks, right? Yep. And 45% in these treasuries. You don't need the dividends from the stocks. You don't need any capital gains from the stocks. You can live off just the interest from the treasuries, at least at the moment. I would say, not knowing anything else about your situation, that seems like a pretty good place to be in, right? Am I missing anything? I'm looking at the chat to help me out. Can you guys bail me out here? What am I missing? I mean, there are obviously other things. What's your situation with Social Security? Obviously, you're too young for it now, but are you eligible for Social Security? Will you be taking that? Do you have any pensions? Are you going to go cold turkey and not earn any income? What's your health situation? Do you have a significant other? What's their situation? Do you have any debt? So there's all kinds of questions that, because I'm not a financial advisor, I'm just a guy with a YouTube channel, that a financial advisor would be asking you and putting into a plan. But from a pure sort of withdrawal rate, asset allocation kind of question, that seems pretty safe to me, unless I'm missing something, which I very well could be. So Michael, another good friend. I haven't talked to him in forever. Oh, no, this is a different Michael. Sorry. The last name. I know a different Michael with almost the same last name. In any event, Rob, what level of risk do you have on all cards if you were to misreport info and cause some loss of revenue? Loss of revenue for who? Like, if there's an interest rate on there that's wrong and you click the link and you go to the bank, you'll see what the interest rate is. And there are disclosures on the site, but I don't know whose revenue I would lose. Like the bank's revenue? Or if someone thought they were getting a different deal? I don't know. I mean, we have disclosures on the site and we do our best to keep the information accurate. But I think it's up to the consumer to make sure that the deal they're signing up for is a deal that they want, right? So anyway, I think that answers your question. But maybe not. I'm just looking here. Let's see here. In any event, interesting question. Okay. Josh says, I want to diversify past VTIAX. Would you do VMAX or VFSAX? Well, VMAX is emerging markets, right? So I must have the ticker wrong. VFSAX. And VFSAX is all world excluding US small cap index. It's a FTSE. I'll show it to you. So if we look at the portfolio, it's a sort of small cap international fund, right? VMAX is emerging market. So if my goal was to go beyond VTIAX, which is, let me just make sure that's the S&P 500, right? Oops. Where's that total? Oh, no. It's not. I'm sorry. It's the total international. Okay. It's like VXUS. Well, so I'm just going to look at this. This fund, VTIAX, has some, I think it has some small cap. So it has some small cap, not much, right? 5%. It has small cap. And it has emerging market, right? Mainly Asia, a little bit in Europe. So when you look at adding VMAX or a small cap international, you're obviously overweighting one of those two. You could buy both funds and overweight both of them, right? If I personally had to choose one, I would probably overweight small cap, I think. But obviously, I can't predict which one's going to do better over any given period of time, or which one's going to have more volatility. I've owned emerging markets in the past, Vanguard's fund. I don't now. I don't think. No. I'm quite comfortable just with one international fund. But I think ultimately the one that's going to be the best is the one you think you're more likely to stick with. Because no matter what you choose given enough time, it's going to have periods of time when it doesn't do well, right? No matter what investing strategy we pick, there are going to be times when it doesn't do as well as we'd like. And the question is always, can we stick with it? And so that kind of question, you have to answer for yourself. But that to me would be how I would think about it. For me, probably adding some more small cap would probably be the way I would do it if I were going to. Yeah. All right. Brian said, did you see that J.L. Collins and his book were mentioned on The Daily Show with Kevin O'Leary as the guest? I read an article. No, I didn't watch the show, but I saw on Facebook that J.L. Collins pointed out, or someone did. I think it was him. It could have been someone else that it was mentioned. So I did know that, yes. All right, from Alejandro, my company is adding a Roth 401k option to the existing 401k plan. Should I split my contributions or move all my money to the Roth? Well, first of all, I can't answer that for you. The way I think about it is based on my tax rates. I mean, ultimately, do I think my tax rates are higher now, or will they be higher when I pull the money out in retirement? And for most people, you can only make a best guess at that. For me, generally, I'm going to want to do a Roth unless I'm in top tax brackets. That's my general sort of probably overly broad rule of thumb. One of the things that a Roth does is it allows you to save more. I mean, the contribution limit isn't different between a Roth and a traditional 401k. But with the Roth, all of the money is yours. With a traditional 401k, some of that money belongs to the government. You may not have to pay them for decades, right? But some of it belongs to the government. So I would really want to be able to take full advantage of the tax breaks, which I would be able to do if I'm in the top federal tax bracket. Maybe I live in a high state income tax state. A Roth might make all kinds of sense. I mean, a traditional. But short of that, if I'm not in that situation, I'm in one of the lower brackets, I personally tend to want to go with the Roth. Yeah. All right. How do I end the poll? Looks like Monday, it got closer, but Monday won. Bringing it into it. And I think, at least in my screen, I've gotten to the bottom. So Josh, I missed a question. Josh wants to know if tilting your portfolio towards small cap and value is worth it or not. So if you put this into Portfolio Visualizer and you go back 50 years, it absolutely is worth it historically. There's been a lot of research, though, done that says, yeah, but it's not clear that it's still worth it. And so where I've come out, I do have some small cap. I have some money in a small cap fund. It's not a small cap value, but a small cap fund. I have no idea if that's going to end up working out better than if I just had total US market. I know, like Paul Merriman, big fan of small cap value, and he's done a lot of research on it. And certainly historically, you can support that. But I'm not at all convinced that going forward, we're going to see a repeat. So I think it comes down to what you can stick with. Another question, do you think the stock market gains will be little in the years to come? So I don't know is the short answer. I mean, I know there are some that say valuations are still high. And so we could be in for a rough decade, could be. There's just too many unknowns. The thing I've just come to learn is I can't make my investing decisions based on some prediction about future stock market returns or future interest rates or future inflation rates, which is one of the reasons I try to cover my bases. It's one of the reasons that I have money in an international fund. I know if you look at particularly the last decade or so, that wouldn't make any sense. You should be all in U.S. stocks, but I'm not convinced that U.S. stocks are going to beat international stocks forever. It's not a prediction that they won't, or U.S. stocks will do poorly compared to international. It's just more a question of taking a more diversified approach because I don't believe I can predict the future. So that may not be a satisfactory answer, but that's my answer. It's 8:28. So I'm gonna end the Q&A. I think I got most of them. So that's over with. But I'm still here. Any non-financial questions before we call it a night? I like non-financial questions. I've gotten a couple. You can just put them in the chat. Oh, Noreen, Mike mentioned Dr. Fowles' retirement planning guidebook, and it is good. It left me with some questions, which is one of the reasons I want to reach out to him. There's this talk. He talks a lot about annuities, both, say, your sort of, your immediate annuity, also variable annuities. One of the questions that I've always struggled with on annuities, just take a single premium immediate annuities, basic, plain, simple, easy to understand, low cost. Let's imagine you've got Social Security, and to meet your sort of basic needs, you need another, just make up a number, $40,000 a year. And so you want to annuitize, you want to buy an annuity to cover that. And then with the money you have left over, you're okay having that in the market. and you'll take out 5% a year or whatever. And some years it'll be good and some years it won't be good, but that's okay because that's for, things over and above your needs, right? Okay. Well, the problem with an annuity is they're not indexed for inflation. So I can buy that $40,000 worth of annuities, annuity payments right now. But as inflation goes up, it's going to cover fewer and fewer of my fixed costs. How do I deal with that? Do I buy $50,000 a year worth of annuities? 60,000? That's the thing that I've not come up with a good answer on. Okay, Steve wants to know, what is my favorite Broadway show? I don't know if I can say I have a favorite, but one that my wife and I saw not long ago, and by that I mean it was before COVID, but is Come From Away. It was really good. It's about 9/11 and the planes landing, and was it Newfoundland or wherever it was? And the actors played multiple roles. It was really good. I enjoyed that a lot. Kat wants to know how my back is. Pretty not bad. I did hot yoga today, Bikram hot yoga, and nothing snapped. So I got that going for me. So Daniel wants to know how I play against the Pirc, or some might say Pircs. I don't know. I'll show you what I play. And I learned this from a book by Larry Kaufman. I'm looking at it. It's right up there, not that you can see it. I can't say that I have much, that I'm a skilled player with the white pieces. I used to play that opening, by the way, as black. So here it is. And let me see if I can get the moves right. There's a couple different ways you can play this. Let me think. We'll go here. We'll go here. Move orders could be wrong, but the point is, okay. So here we are, and what he proposed was this, which is somewhat unusual: Bishop F4. I tend to then follow up with Queen D2 and Long Castle, and then throw my pawns at the black king side. Yeah, that's what I do. Okay. By the way, back to the question of my back. I mentioned last week or week before, whenever, about convict conditioning. Is that what it's called? I think so. It's basically a calisthenics program. And I've been doing that, and it's really good. I'm amazed at how sore I am after a workout that didn't seem that hard. So I'm very happy with it. No weights involved. One of the things one of the exercises is a one-arm handstand push-up. Now, I cannot do a one-arm handstand push-up. In fact, you progress through 10 stages to get to that. I'm at stage 1. And stage 1 is doing a headstand up with your feet up against a wall. So there I am in my basement the other day. I get a little towel down. I'm getting down there to do a headstand, and I'm thinking, okay, this could go horribly wrong. But the good news is no one was there to watch, and I just hope I didn't break anything, myself, a TV, whatever. I was pleasantly surprised. Got into the headstand without any issues. I kind of felt like I knew what I was doing. I managed to hold it for like 30 seconds. Now this was, again, feet up against the wall, so I wasn't, whatever. Well, it's 8:33. So I'll end with this one from Kim. What would you have chosen if you didn't go into law? Probably computers is what I would have chosen. Now, this would have been in the 80s, so they're not quite, like what we know today. But I really do like programming. I'm not particularly good at it. I do some programming for my site. It's mainly PHP. And I like it a lot. So that's probably what I would have done. So there you go. All right. So Monday one out. So I think it's the 20th is the next one. Again, I'll confirm all of this in the newsletter. So if I have to make a change to the schedule, I'll put it in the newsletter. So subscribe to that if you haven't. It goes out every Sunday morning. And some people like it. I think that's it. All right, guys. Have a great, and gals, have a great week. Hope you're all doing well. And remember, until next time, the best thing money can buy is financial freedom. And I'm out.